There is trouble brewing in the Canadian real estate market. Everyone involved in the industry knows that it's coming, but still, the overwhelming majority of homeowners remain blissfully unaware of the turmoil that could be coming their way. And it's not like we don't have plenty of time to get ahead of this in this nation, but even though channels like mine talk about these problems that are on the horizon, still less than 30% of you watching this channel are even subscribed. And that means that there's a really good chance that over 70% of Canadians aren't paying attention to the impending doom that has the possibility of rearing its ugly head in 2025 and 2026. And if you don't like my normal education-based content here pumping the Canadian real estate market, well, you're in luck, because today's video is about the possibility of a housing smackdown that could be headed our way. So if you're watching this from your parents' basement as a grown adult, wishing for massive pain in the Canadian economy because you think for some stupid reason that since you couldn't buy a house until this point, that when the economy comes crashing down and house prices along with them, that somehow you'll be left unscathed, and then finally, you will become a real estate tycoon, well, then you should go ahead and click the like button for the YouTube algorithm, because you are going to love this doom and gloom video. And if you agree with this video and what might be headed our way, that means the real estate market in Canada is about to crash. So you can book your call with me right now to get your home sold so you don't get caught holding the bag. And now on to the video about why I think we could actually see a massive decline in housing prices in about 2 or maybe 3 years. Now, as I said, if you're not paying attention and you have a mortgage, well, you had better start paying attention. After all, variable rate mortgage holders are already getting higher bills as interest rates have increased. And many fixed payment variable rate mortgage holders have already been triggered. But you folks that like to play it safe like I do and lock in for 5 years at a time, well, many of you don't understand that rates have gone from 1.49% at the end of 2020 to now as high as 6.3% or more for the same fixed term product. This means that for every $100,000 that someone borrowed in 2020, they likely owe about $399 per month for 25 years. But assuming now they will have to renew in 2025, if that rate stays at, say, 6.3% where they are now, those payments for those people will increase to $662 per month for every $100,000 borrowed, or about a 60% increase in payments. Now, let's say you took out, a $750,000 mortgage in December of 2020, and your payment at that time was set on a 5-year basis at $2,996 per month. Well, if rates don't move over the next year or so, your new payment could be $4,549 if you keep the same amortization. Or to get the cost down, because now you owe a lot less, you may back out to that 25 years, and your new payment could be $4,109 per month. Yep. Many homeowners are not paying attention to the fact that their mortgages could increase easily by $1,000 per month or more. And sure, you can think that, well, if things get that bad, I'll just sell my house, because after all, house prices have absolutely killed it since 2019, right? Well, if we continue to see these rates, and personally, I think that rates could easily hit 7% or higher before they come down, that will in fact lower home prices as affordability gets worse and new home buyers entering the market are qualifying for less and less and less. So you may not be able to sell and make money. And many Canadians may even have to sell at a loss. And that could cause a lot of people to be in a negative equity position. And well, that is where the trouble starts. This is actually what happened in 2008 and over the next few years in the US. Now, we don't have the same ninja loans that they did that led up to the whole problem kicking off in the first place. And we're not lending at 125% loan to value like they were. So the problem, I don't view it as being nearly as big, or at least the kickoff will not be. However, the renewals of mortgages could be just as bad, because we could have it where people can't actually sell and have enough to close and clear title. And if they can't make those new payments with their new interest rates, they're stuck. Because one thing that did happen in the States is many people wanting to keep paying their mortgages from, let's call it 2009 through 2014. At that time, the banks would not renew their loans. And they definitely would not offer lower rates, even if those rates would save the economy. Now, because one of my best friends lives in the States and has actually gone through the experience, I have a little bit of firsthand knowledge of what this may have looked like going down. Now, these aren't exact numbers. They're only kind of really rough calculations to use as an example. But let's say it went something like this. If you bought a house in 2007, somewhere in the States, for $400,000 by 2009, after the crash, after the whole Lehman Brothers thing, that home could have very well have been worth $240,000 or less. Then in 2012, when you went to renew that first part of what they call down there an ARM, which is very similar to our 5-year fixed payments here, that homeowner might be told that their payment would go from, I don't know, maybe $2,100 a month to now over $4,000 a month. And remember, this homeowner in this situation would love to keep the home. But the banks down there at that time, they wouldn't budge. Because you think, wouldn't it be in everybody's best interest to maybe just keep those payments going, maybe not at the $4,000 a month, but at the $3,000 a month on what's probably owed on a home like that? Let's call it $375,000 or more on the balance. Nope. If you couldn't come up with that now over $4,000 a month payment, the bank would start to foreclose. Well, in the States, this happens so often, they didn't even bother foreclosing anymore. And then that procedure was replaced with something called short selling. Short selling is when you don't go all the way through foreclosure, but the bank takes the loss in the selling of the home to a new buyer. So think about that. They wouldn't let you, as a homeowner that couldn't make the $4,000 a month, keep paying, say, $3,000 a month on $375,000 owing, but they would sell the property to a new owner at $240,000 and take the loss on the rest. So that leaves the question is, will that happen here in Canada? And the answer to that is it could. Because nationally famous economist Benjamin Tao from CIBC says that if the overnight lending rate is not 2.75% or lower by the end of 2025, that is when we will see a massive amount of pain in the Canadian housing market. Now, I'm a little bit more hopeful than that personally. I think as long as we come down to a 5-year fixed rate around that 5.25% that is the minimum stress test level, well, I think Canadians overwhelmingly will be okay. And that is why I think it's in the Bank of Canada's best interest to keep increasing interest rates over the short term to eventually make those cuts happen sooner, because we need them to come sooner. But the only way rates will come down is if we experience pain in the economy and inflation comes under control. And then that pain relief will come in the form of lowering the overnight interest rate. And that is the exact reason why I always tell people that they need to make sure they have staying power in the market. For example, if you're an investor right now and you are just barely hanging on, well, my advice is you better bail out while you can, because holding on, hoping that the spring market is going to bail you out is, in my estimation, foolish. And if you don't have staying power, regardless of rates, for 5 to 10 years, well, then you shouldn't be a real estate investor in the first place. And that goes for homeowners as well. You need to start preparing for what you will do if rates are as high as they are now when it comes time for your next renewal. Start with paying a little extra down now. Every extra penny you put on your principal now will help lower your payment upon renewal. Or pay down other debts first now to free up money for the future. These are often higher interest rate loans, credit cards, and even car loans, because you may need to totally restructure your home financing in the future. And getting rid of other debts will help you do that. And understand that if you're in a pinch now, the most likely situation for you in the future might be to re-amortize back out to 25 or 30 years so you can keep your home. You'll end up paying a lot more interest over time, but it will help you keep your home and lower your payments until rates do come down. And personally, I don't think that's going to be for the next few years. And last, let's face it, some people who haven't been good with their finances and have buried their heads in the sand, well, they are going to be forced to sell. And remember, there is no shame in admitting that you need help. And if you find yourself in that situation and you live in my market of Surrey and the Fraser Valley, well, you can book a call with me right now using the link in the description below at a time that works best for you. Until then, subscribe, click the like button, pull your head out of the sand, and we'll see you in a couple of days.